I made my first million at 40, my first billion at 75. Know what the difference was? I stopped doing stupid things. You see, everyone's looking for the secret to getting rich. The magic stock, the perfect timing, the insider tip. There is no secret. There's just a checklist of idiotic mistakes, and if you avoid them, you win. I've spent 60 years watching smart people destroy themselves. Same mistakes over and over. And you're making them right now. 7 mistakes that will cost you decades, not months, not years, decades of your life. Most people don't figure this out until they're 60, broke, angry, blaming everyone else. I'm giving you the checklist today. If you're making even 3 of these, you're already 10 years behind. Let's see which ones. This is the Munger method. No hype, no predictions, just what works when everything else fails. Let's go. So mistake number 1, you're learning from your mistakes instead of other people's. Wrong approach. Completely wrong. Look, I'm not smart enough to make every mistake myself. I don't have that much time. Neither do you, so I read obsessively. Not self-help garbage, not success stories, failure stories. I studied every major stock market crash, every corporate fraud, every bankruptcy. Why? Because the same patterns repeat, the same stupid decisions, the same warning signs everyone ignores. You think you're different? You think when the next bubble comes, you'll be the one who sells at the top? No, you won't, unless you study what happened to the idiots who didn't. I read about the South Sea bubble. Happened in 1720, 300 years ago. And people still fall for the same scam today. Different name, same stupidity. Tulip mania, railway mania, dot-com bubble, housing bubble, crypto bubble, same pattern every single time. Mass delusion, this time is different. It's never different. I studied the Great Depression. I wasn't even born yet, but I damn well learned what not to do. I read about people who lost everything because they borrowed money to buy stocks. Margin calls wiped them out. So what did I learn? Don't use leverage, ever. If you can't afford to own it outright, you can't afford to own it. I read every biography I could find, not to be inspired, to catalog mistakes. Andrew Carnegie made mistakes. John D. Rockefeller made mistakes. Even Ben Franklin screwed up investments. He bought into some ridiculous scheme that went bust. But I don't have to repeat them, because they already wrote it down. They documented their failures. All I had to do was pay attention. And here's what you do instead. You lose money in crypto. You act surprised, like you're the first person to fall for a get-rich-quick scheme. You buy a stock at the top, it crashes, you're shocked, but it happened in 2000 and 2008 and 1987 and 1929. The information was there. Thousands of books about it, documentaries, case studies. You just didn't read them because you were too busy watching videos about the top 10 stocks to buy now. And here's the thing about learning from other people's mistakes. It's not just cheaper, it's faster. I compressed 300 years of market history into a few years of reading. I learned what killed investors in the 1000, 800s, the 1900s, every decade. I didn't have to live through every crash. I didn't have to lose my money in every bubble. I just had to read about the people who did. So here's what you do. Read 1 investing disaster case study per month, just 1. Dot-com bubble. Read about Petscom and Webvan, companies that raised billions and went to zero. Read about 2008 financial crisis. Lehman Brothers, Bear Stearns. How did they collapse? What were the warning signs? Long-term capital management. Oh, this is a good one. Hedge fund run by Nobel Prize winners. Geniuses. They built a model that said their strategy would only lose money once every 1,000 years. They lost everything in 4 years. How? Why? Read about it. Read about Enron, not just they committed fraud, how did they commit fraud, what accounting tricks did they use, why did smart auditors miss it, why did analysts recommend it all the way to bankruptcy. Read about the Tesla shorts who lost billions betting against Elon Musk. What did they get wrong? Read about Bill Ackman losing $4 billion, 0 cents on Valiant Pharmaceuticals. What did he miss? Each one of these stories saves you from making that mistake yourself. Boring? Yes, but losing your money is more boring. Trust me. All right, mistake number 2. You're buying things you don't understand. This one drives me absolutely crazy. I have a simple rule. If I don't understand it, I don't buy it. Period. End of story. Sounds obvious, right? Then explain to me why you bought crypto in 2021. Can you explain how blockchain works? Can you explain mining? Can you explain proof of work versus proof of stake? Can you explain why Bitcoin has value? No? Then you weren't investing, you were gambling, and now you're mad that you lost. Here's what kills me. You spend an hour researching a $50 0 cents toaster on Amazon, reading reviews, comparing features, checking if it has a bagel setting, but you'll throw $10,000, 0 cents, into a stock because some guy on Reddit said diamond hands to the moon and posted a rocket emoji. Makes perfect sense. I passed on thousands of investments, huge winners, companies that went up 50x, 100x, and I slept fine. Why? Because I didn't understand them. And I'd rather miss a winner than lose money on something I don't get. That's the deal. You can't win them all, but you can avoid losing on stupid things. I passed on tech stocks in the 90s. Didn't understand them. Everyone said I was an idiot. You don't understand the internet, old man. Maybe, but I also didn't lose money when they all crashed. I passed on Amazon early on. Didn't make sense to me at the time. Jeff Bezos was losing money every quarter and people were calling him a genius. I didn't get it. Did I miss out? Sure. Amazon went up 100,000%. Oops. Did I lose money? No. And that's the point. Here's the thing people don't get. When you only invest in things you understand, you avoid 90% of disasters. You'll miss some winners, but you'll never lose everything on some fraud or bubble you didn't see coming. I never bought Enron, never touched WorldCom, never invested in mortgage-backed securities before 2008. Why? Because I didn't understand them. Or I did understand them and realized they were garbage. Either way, I kept my money. Meanwhile, brilliant people, I'm talking PhDs, hedge fund managers, professional investors, they lost billions on stuff they thought they understood but didn't. They got greedy, they got complicated, they wanted to look smart, so they bought complex derivatives and structured products and leveraged instruments, and they got wiped out. Well, here's the test. Can you explain your investment to a 10-year-old? I own part of a company that sells soda. People like soda, they buy it every day. Company makes money, gives some to me. That's Coca-Cola. Simple, understandable, been around since 1886, still selling sugar water, still making money. Now try explaining this. I own a synthetic collateralized debt obligation that leverages proof-of-stake consensus mechanisms to yield farm governance tokens in a decentralized autonomous organization. What the hell does that even mean? If you need 15 minutes and a whiteboard to explain your investment, you don't understand it. You're just repeating words you heard on YouTube. And here's another test. Can you explain how it makes money? Not why the price will go up. That's not investing. That's speculation. That's hoping some bigger fool buys it from you later at a higher price. How does the business generate cash? Where does the profit come from? If you can't answer that in one sentence, you're gambling. So go through every investment you own right now. every stock, every fund, every crypto token. Ask yourself one question. How does this make money? If you can't give a simple, clear answer, sell it today, right now, because you're about to learn an expensive lesson, and I'm trying to save you from it. Mistake number 3, you're in a hurry. You want to get rich by Thursday. Not happening, never happening. Look, I built my wealth over 60 years, not 6 months, not 6 years, 60 years. And people ask me all the time, what's the secret to getting rich quick? There isn't one. That's the whole secret. There's no shortcut. There's no hack. There's no loophole. Just time and compound interest. The big money isn't in the buying. It's not in the selling. It's not in timing the market or finding the next Amazon. It's in the sitting, the waiting, the doing nothing. But you can't sit still, can you? You can't do nothing. It kills you. You see someone make 200% on a meme stock in 3 weeks, and you panic. I'm missing out. Everyone's getting rich but me. I need to do something. So you start trading, day trading, swing trading, options, crypto, chasing every hot tip on Twitter and Reddit and TikTok. And 5 years later, you've gone absolutely nowhere, actually worse than nowhere, because you paid fees and taxes on every stupid trade. Meanwhile, the boring guy who bought an index fund 5 years ago and forgot about it, he's up 60, 70, 80%. He doubled his money. He's sleeping well, not checking his phone every 5 minutes, not having a panic attack every time the market drops 2%, not arguing with strangers on the internet about why his stock is going to moon. Here's the math you don't want to hear. 20% per year. Doesn't sound exciting, does it? It sounds boring. It sounds slow. But 20% per year for 60 years turns $10,000, 0 cents, into $500 million. That's not a typo. That's not a mistake. That's compound interest. That's what Einstein called the eighth wonder of the world, not because it's flashy, because it works. But you don't want to wait 60 years. You want it now. You want to be a millionaire by 30. So you take risk, big risk, stupid risk. You use leverage. You trade options. You go all in on speculative garbage. And you know what happens? You lose it all, or you make some money, get cocky, lose it all on the next trade. You don't need home runs. You don't need to find the next Tesla or Bitcoin or whatever. You need to avoid strikeouts. Hit singles, get on base, don't swing at bad pitches. That's it. That's the whole game. But your ego won't let you play it that way. You want to brag at parties. I made 500% this year. You want to screenshot your portfolio gains and post them on social media. You don't want to say, I'm slowly compounding wealth over decades by investing in boring companies and index funds. That's not cool. That's not impressive. Nobody's going to give you likes and comments for that. But it works. And your way doesn't. Here's your reality check. If you've been investing for 5 years and you're not beating a simple S&P 500 index fund, you're not an investor. You're a gambler with a losing record. The S&P averages about 10% per year over the long term, just sitting there, doing nothing. No genius required, no special knowledge, no hot tips. If you're doing worse than that, after all your research, all your trading, all your stress, all your subscriptions to trading newsletters and premium Discord groups and stock picking services, you're literally better off doing nothing. Just buy the index fund, set it and forget it, go live your life, play with your kids, learn a hobby, check back in 30 years, you'll be rich. Not exciting, but correct. And here's the really brutal part. Most active traders don't beat the index. We're talking 90% of active traders underperform a simple index fund over 10 years. 90%. Those aren't good odds. You're not special. You're not the exception. You're part of the 90% losing to a robot that costs $3.00 a year in fees. All right, mistake number 4. You think diversification means owning everything. This is where Wall Street really screws you over. They love telling you to diversify. Don't put all your eggs in one basket. Spread your risk. Sounds smart, right? So you do what they say. You buy 50 stocks. You buy international funds. You buy bonds and REITs and commodities and crypto and gold and silver. You own everything. Congratulations. You've achieved perfect diversification and you own nothing. Here's what I actually said about this. Diversification is protection against ignorance. It makes very little sense for those who know what they're doing. Read that again. Diversification is for people who don't know what they're doing. If you actually understand investing, you don't need 50 positions. You need 6, maybe 10 if you're feeling cautious. At one point, 90% of my net worth was in one company, Berkshire Hathaway. Was I crazy? Was I reckless? No, I understood that business, inside and out. I knew how it made money. I knew the people running it. I knew Warren for 50 years. I wasn't diversified. I was concentrated in what I knew, and it worked out pretty well. Last time I checked, I died a billionaire. Now look, I'm not telling you to put 90% of your money in one stock. Unless you're me or Warren Buffett, you probably shouldn't. But here's the problem with over-diversification that nobody tells you. When you own 50 stocks, you basically own the entire market, which means you get market returns about 10% per year. Fine. But you also can't possibly understand 50 businesses. Nobody can. You don't have time to read 50 annual reports, follow 50 management teams, understand 50 different industries. So you're not really investing, you're just building a do-it-yourself index fund with more work, higher fees, more taxes, and probably worse returns because you'll make mistakes picking those 50 stocks. You'd literally be better off just buying an actual index fund and saving yourself the headache. Here's the smarter approach. Own 8 to 12 businesses you understand. Not 50 names you picked from a stock screener because they had good P/E ratios. Not everything because you're scared and you don't know what else to do. A concentrated portfolio of businesses you've actually researched. Companies you understand. Industries you follow. I said, if you can identify 6 wonderful businesses in your lifetime, that's all the diversification you need. 6, not 60. 6 truly great companies that you understand, that have durable competitive advantages, that are run by honest and competent people. Buy them, hold them, get rich slowly. And if you don't deeply understand individual businesses, if you don't want to read annual reports and follow earnings calls and study competitive dynamics, then just own an index fund. Seriously, that's not a failure. That's self-awareness. That's actually smart. Most people would be way better off in an index fund than pretending they're stock pickers. There's no shame in it. The shame is in owning 50 stocks that you don't understand, underperforming the market, paying unnecessary fees and taxes, and wasting your time. That's shameful. So here's what you do. If you own more than 20 individual stocks right now, you're over-diversified. Cut it down. Keep only the ones you truly understand and believe in. If you can't explain in one sentence why you own it and how it makes money, sell it. Today. And if that means you end up with just 5 stocks or an index fund, good. You've just improved your portfolio and saved yourself years of mediocre returns. Mistake number 5. You're hemorrhaging money on fees and taxes and you don't even notice. This one's boring, I know. Nobody wants to talk about expense ratios and tax efficiency and fee structures, but it's costing you tens of thousands of dollars, maybe hundreds of thousands, maybe millions over a lifetime. Let me show you some math. Pay attention because this is important. Let's say you're investing $10,000, 0 cents per year for 30 years. Pretty standard. Scenario 1, you use a low-cost index fund, 0.04% expense ratio, basically free. You buy and hold, don't touch it, don't trade. At 10% annual returns, you end up with about $1,800,000, 0 cents. Nice. That's a good retirement. Scenario 2, you use an actively managed mutual fund, 1% annual fee. That doesn't sound like much, right? Just 1%, one measly percent. Same 10% returns before fees, but after fees, you actually get 9% per year. You end up with about $1,500,000, 0 cents. The difference? $300,000 gone, vanished into your fund manager's pocket for the privilege of underperforming the index. That's not a typo. A 1% fee costs you $300,000, 0 cents over 30 years, for nothing. Actually worse than nothing, because most actively managed funds don't even beat the index. So you're paying more to get less. Brilliant. And that's just expense ratios. That's just the annual fee. Now add trading commissions if you're constantly buying and selling. Add bid-ask spreads. Add capital gains taxes every time you sell something for a profit. Short-term capital gains, if you held less than a year, can be taxed at 37%. Your top marginal rate. Long-term capital gains are 15 to 20%, still significant. Most active traders are giving away 30 to 40% of their gains to fees and taxes. Then they wonder why they're not building wealth. I'm up 50% on my trades this year. Great. After taxes and fees, you're up 30%. Congratulations. You worked your ass off, stressed for 12 months, and barely beat the index fund that required 0 effort. Warren and I obsess over this for decades. We held stocks for 30, 40, 50 years to avoid paying capital gains taxes. Why sell? You pay taxes, you lose 20% right off the top. Now you have to find another investment that's 20% better just to break even. Stupid. Berkshire Hathaway doesn't even pay dividends. You know why? Because dividends are taxed immediately. The government takes their cut before you can reinvest it. We'd rather keep the cash inside the company, reinvest it in more businesses, and let it compound tax-free for decades. That's how you build generational wealth. Not by paying taxes every year on dividends and capital gains. But what do? You trade constantly. You sell winners too early because you're scared of losing your gains. You hold losers too long because you're too stubborn to admit you were wrong. Every trade equals fees. Every short-term sale equals higher taxes. You're working against yourself. You're bleeding money, and you don't even realize it. So here's what you do. Calculate how much you paid in fees and taxes last year. Actually do this exercise. Go to your brokerage account. Look at your 1099 tax form. Add up your capital gains taxes. Add up your trading commissions. Add up your expense ratios if you're in mutual funds or ETFs. Add it all up. If that number is more than 1% of your portfolio value, you're trading too much. You're paying too much. Cut it out. Switch to low-cost index funds. Stop trading. Hold for the long term. I'm serious. This might be the single most important piece of advice I can give you. Minimize fees and taxes. It's not sexy, it's not exciting, but it might be worth an extra $500,000 to you over your lifetime. Pay attention. All right, mistake number 6. You let your emotions make your decisions. This is the big one. This is what destroys most people. This is why smart people with good intentions end up broke. Your biggest enemy isn't the stock market. It's not the economy. It's not China or inflation or interest rates or Jerome Powell. It's you, your emotions, your fear, your greed, your panic, your FOMO. When the market crashes, you panic and sell everything. When the market's booming, you FOMO and buy at the top. You do the exact opposite of what you should do. Buy low, sell high, great advice. Everyone knows it. Nobody does it. You know what people actually do? Buy high when everyone's excited and everything feels safe. Sell low when everyone's panicking and it feels like the world is ending. Every single time, like clockwork. Let me give you some real examples. March 2020, COVID hits. Nobody knows what's happening. Market crashes. S&P 500 drops 34% in 1 month. Fastest crash in history. Panic everywhere. News channels showing death counts 24/7. Everyone's terrified. What did most people do? Sold everything. It's going to zero. This is the end, the next Great Depression. Cash is king. What did we do at Berkshire? Nothing. We sat there. Actually, we bought more. Market was on sale. Great businesses trading at huge discounts. Why would we sell? And what happened? Market fully recovered by August. Hit all-time highs by the end of the year. Everyone who panicked and sold at the bottom, they locked in their losses permanently. Then they were too scared to buy back in. They missed the entire recovery, the greatest buying opportunity in a decade, and they did the opposite of what they should have done. Then 2021 comes. Market's booming. Everything's going up. Crypto's going insane. Bitcoin hit $60,000, 0 cents. Dogecoin, NFTs, meme stocks, GameStop, AMC. Everyone's making money, or so it seems. This time is different. New paradigm. Fed money printer, go burr. What did most people do? Jumped in with both feet. I'm missing out. Everyone's getting rich but me. I need to get in now. FOMO is a hell of a drug. What do we do at Berkshire? Nothing. Actually, we were sitting on $150 billion, 0 cents in cash. Just sitting there, doing nothing. People called us idiots. Buffett and Munger are too old. They don't get it. They don't understand crypto. They don't understand memes, boomers. This time is different. We heard it all. And what happened? 2022, market crashes, crypto crashes, Bitcoin dropped 70%, done all those meme stocks, gave back everything. NFTs became worthless JPEGs. All those diamond hands turned into paper. All those people who bought at the top in 2021, most of them are still underwater, still hoping to break even. Meanwhile, we had $150 billion, 0 cents in cash, ready to deploy when everything got cheap again. Here's the pattern you need to understand. When you feel like you should sell, when your gut is screaming at you to get out, when you're checking your portfolio every hour and you can't sleep at night, that's usually when you should hold or buy. When you feel like you need to buy, when everyone around you is making money and you're missing out, when it feels like easy money and you'd be an idiot not to get in, that's usually when you should wait or sell. Your emotions are designed for short-term survival. Run from the lion, fight the enemy. Don't eat the poisonous berries. Great for keeping you alive in the jungle, terrible for building long-term wealth. Your short-term panic instincts will destroy your long-term financial future. So here's what you do. Write down your investment rules. Right now, not during the next crash, not during the next bubble. Right now, when you're calm and rational and not emotional. Write them down. I will not sell during a market crash unless I actually need the money for living expenses. I will not chase hot stocks just because they're going up. I will not check my portfolio more than once a month. I will not make investment decisions based on fear or greed. Whatever your rules are, write them down, print them out, put them somewhere you'll see them. And when the next crash comes, and it will come, and your emotions are screaming at you to do something stupid, read your rules. Follow them. Not your feelings. Your feelings are trying to kill your financial future. Mistake number 7, and this is the killer. This is the one that destroys more wealth than all the others combined. You quit too early. You give up right before it works. Most people try investing for 2, 3, maybe 5 years. They don't get rich. They get frustrated. They get bored. They quit. They say, investing doesn't work. The game is rigged. Only the rich get richer. The little guy can't win. And they go back to buying lottery tickets and complaining about the system. Here's what they don't understand. Wealth compounds slowly at first. Very slowly. Painfully slowly. For the first 10 years, it feels like nothing's happening. You're putting in money every month. The numbers go up a little, then down, then up a little more. It's boring. It's frustrating. You look at your account after 5 years and you think, that's it? After 5 years of discipline and saving and investing, that's all I have? This is bullshit. I get it. I understand the frustration. But here's what happens if you keep going. You're 15, you're 20, you're 25, you're 30. Suddenly the numbers start moving fast, really fast, because you're not just earning returns on your contributions anymore. You're earning returns on your returns. You're earning returns on the returns of your returns. That's compound interest, and it's exponential, not linear. The first $100,000, 0 cents, takes forever. Feels impossible. You're grinding, saving, investing, and it takes years to hit that milestone. But the second $100,000, 0 cents, happens way faster. The third, even faster. By the time you get to your fifth or 600,000, they're coming every year or two. That's the magic of compounding. But you only get there if you don't quit. I didn't make serious money until I was in my 50s. Didn't make my first billion until my 70s. That's 30, 40, 50 years of doing the same boring things over and over, buying good businesses, holding them, reinvesting dividends, letting it compound, not selling during crashes, not chasing bubbles, just being patient and disciplined for decades. Most people don't have that kind of patience. They want results now, and when they don't get them, they quit. They try stocks for a few years. It doesn't work, they switch to real estate. That doesn't make them rich fast enough, they try crypto. That blows up, they try options trading. That loses money, they try day trading. That loses more money. They spend their entire lives jumping from strategy to strategy, never sticking with anything long enough for it to actually work. Well, here's the truth nobody wants to hear. The stock market has returned about 10% per year for the last 100 years. Through world wars, through the Great Depression, through recessions and crashes and bubbles and panics and everything else. 10% per year on average. That means if you invest consistently and don't do anything stupid for 30 years, you will build significant wealth. Not maybe, not probably, you will. It's math. It's inevitable. But you'll be tempted to quit. Oh, you'll be so tempted in year 3 when there's a crash and you're down 30% and everyone's saying it's the end of the world. In year 7, when your buddy made 500% on some cryptocurrency and you're only up 80% and you feel like an idiot. In year 12, when it feels like you're running on a treadmill going nowhere and you're wondering if this is even worth it, that's when most people quit. Right before the exponential growth phase kicks in, right before all those years of patience start paying off, big time. Don't be that person. Don't quit. You've already done the hard part. You've already suffered through the slow years, the boring years, the years where it feels like nothing's happening. If you quit now, all that was for nothing. But if you keep going, if you give it another 10, 20 years, you'll be in the top 5% of wealth in this country. Guaranteed. So here's my last piece of advice, and then I'm done. Pick a strategy. Index funds, dividend stocks, value investing, whatever. Something boring and proven. Something that's worked for decades. And then stick with it for 30 years minimum. Not 3 years, not 5 years. 30 years. Don't quit when it's hard. Don't quit when it's boring. Don't quit when your friends are making more money doing something else. Don't switch strategies every 2 years chasing the next hot thing. Just keep going, keep contributing, keep reinvesting through crashes, through booms, through boredom, through FOMO, through fear. Just keep going. That's it. That's the whole game. Avoid these 7 mistakes. Be patient, be disciplined. Don't quit. You won't get rich in 5 years, probably not in 10 either. But in 30 years, you'll be wealthier than 95% of people in this country. And you'll have done it without stress, without gambling, without getting lucky, just by being patient and not being stupid. Now, if you made it this far, you're serious about this. Most people already clicked away looking for top 5 stocks to 100x in 2024, or whatever garbage is trending. Good. Less competition for you, more opportunities for patient people who actually understand how this works. Hit that subscribe button if you want more of this. No hype, no hot takes, no predictions that'll be wrong in 6 months. Just timeless principles that worked 50 years ago and will still work 50 years from now. That's what this channel is about. Come out. Go do boring things that make you rich.
这段视频深刻剖析了人们在财富积累过程中常犯的7个愚蠢错误，揭示了投资成功的真正秘诀并非寻找捷径，而是坚持查理、芒格所倡导的反向思维，通过避免错误来获得成功。视频开篇即指出，许多人穷尽一生寻找致富秘诀，却忽视了犯下大量基本错误。主要错误包括只从自身错误中学习而非借鉴他人经验，盲目投资不理解的事物，急于求成寻求快速致富，过度分散投资导致一无所获，因高昂费用和税费流失财富，让情绪左右投资决策，以及在成功前过早放弃。演讲者强调了耐心、长期复利、深入理解投资标的、最小化费用与税收，以及坚守纪律的重要性。他以亲身经历和市场历史为例，说明了坚持正确原则，即使过程乏味，也终将带来显著的财富增长。视频旨在帮助观众认识并规避这些常见陷阱，从而在数十年内稳健地实现财务自由。